Hi and welcome to Swissquote's Daily Market Talk. It's Monday, 10th of August. The latest data shows that the corporate profits are booming on both sides of the Atlantic Ocean, while the economic data is sending some worrying signals. But the latter is not necessarily bad news for the markets, as soft economic data strengthens the expectations that the central banks around the world could refrain from raising their interest rates for longer, and that is giving further support to asset prices today. So that combination of strong profits, strong corporate earnings, softer economic data, and easing global yields is keeping markets near record high levels this Monday morning, and that despite persistent oil and geopolitical risks, as investors' attention is shifting towards the US CPI update that's due this Wednesday. So we will talk about all that and more. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So last week's news and data were rather supportive of the market mood because first, the earnings season is going quite well. I mean, much better than the already strong expectations. In the US, for example, with 88% of the S&P 500 companies having already reported their second quarter results, the numbers are pointing at an earnings growth rate of 50.4%. If that 50.4% is the actual growth rate, it will mark the highest earnings growth rate reported by the index since the second quarter of 2021. At that time, we had around 91.6% earnings growth. The revenue growth is very strong as well, around 15% in the second quarter of this year. That's also the highest earnings growth rate since the fourth quarter of 2021. And energy sector is obviously the biggest winner of the second quarter among the other sectors, thanks to the soaring energy prices due to the Middle East war. The S&P 500's energy companies actually printed a revenue growth of 42.5% in the second quarter, and that was followed by technology companies that printed a nearly 36% revenue growth. Chip makers outperforming with a 77% growth in their revenues in the second quarter. Interestingly though, these blockbuster results from the chip makers around the world, and the South Korea as well, remember, has mostly failed to impress investors this earnings season. We saw pretty much the same better than expected earnings, leading to a notable market sell-off in the Korean and US chip makers in this earnings season. The last example of that being AMD's almost 7% loss posterior to their earnings announcements. And this morning, the Korean Kospi Index, which has become the bellwether of the chip makers, opens the week with little enthusiasm. The index is actually trading flat this morning. That's well in contrast with the 5 to 10% intraday moves of the past few months, as the June-July sell-off that we saw there clear speculative positions massively, leaving many investors bruised, obviously. But the volatility in the Korean Kospi Index is also coming lower. That's probably a good sign, but we are not there just yet. Elsewhere, investors were in a better mood actually. SpaceX, for example, announced lower than expected loss last week for the second quarter, and investors praised the stock with a 20% jump, also easily absorbing the additional supply that hit the shore at the end of the first lockup period for SpaceX. Palantir, on the other hand, saw nearly 40% last week after beating earnings forecasts, and the latter also improved sentiment broadly across the big technology companies that were earlier battling with the uneasy questions regarding their quickly evaporating free cash flow levels. Funnily, on that matter, I left for my summer break about 2 weeks ago with investors so worried about Alphabet's free cash flow turning negative that they haven't even reacted to the 82% cloud growth. Amazon and Meta also printed a sharp decline in their own free cash flow levels following the Alphabet due to massive AI spending, obviously. Meta's free cash flow was barely positive in the second quarter, while Amazon's free cash turned negative on trailing 12-month basis. Now, the fastest cloud growth in 18 quarters helped Amazon's stock price gain, but overall questions were floating in the air. But as I return to my desk today, the volatility remains high, but investors are kind of warming up to the idea that extra AI investment will be increasingly relying on debt. And if cloud revenues from these big technology companies could eventually justify the heavy spending, while the investors would be there to give it another shot. This is what last week's jumbo bond sale from Alphabet suggested. The demand for the Alphabet bonds was strong. 4 times oversubscribed strong, and that is obviously a sign that the earnings season hasn't been that bad for the big technology companies after all. Here in Europe, the second quarter earnings season has been also surprisingly strong. The Stoxx 600 companies are now expected to deliver around 22% earnings growth. That's also the strongest pace since 2022 and well above the roughly 14.5% earnings growth expected by analysts at the start of this earnings season. And here as well, energy is doing much of the heavy lifting for the European stocks thanks to the surge that we saw in oil and gas prices following the Middle East war and the impact on oil prices. The improvement in Europe has also broadened beyond the energy sector despite the energy crisis. Earnings growth excluding energy is now expected to be around 12%, roughly double the 5.5% expected before the season kicked off. So the Stoxx 600 index is also trading at record high levels with further upside potential, as Europe may be trailing the spectacular 50% earnings growth seen in the US, but the direction of travel has been clearly positive here as well, and surprisingly positive, with companies comfortably beating the relatively cautious expectations they entered the season with. Of course, some specific sectors like airlines are feeling the pinch, but overall, we are having a very, very strong earnings season on both sides of the Atlantic Ocean. As such, the major US and European indices are preparing to kick off the new week near record high levels, and there is not much to dampen the investor mood today, except for a positive pressure in oil prices perhaps. US crude may test the $80 per barrel level to the upside again on the Middle East mess, as US is saying that an agreement, a peace deal is closed, while Iran is not even willing to meet directly with the US. But looking at the corporate earnings of the second quarter, that energy crisis, nor tariffs, nor overshooting chip prices, nothing could derail companies from doing good business. In contrast, though, the macroeconomic data is unfortunately telling a completely different story. Different, however, not being necessarily negative for the markets or investors. Because look, Friday's jobs report showed that the US economy, and despite that 50% earnings growth from the S&P 500 companies in the second quarter, shed 23,000 jobs in the month of July versus 85,000 job additions penciled in by analysts, and wages in the US grew 3.2% over the year only. That's also slower than 3.5% expected by analysts. Now that's bad news for people, but that's quite good news for asset prices, hence for investors, because people who actually lose their jobs and who see their wages grow slower will be tempted to spend less, and the latter would tame inflationary pressures and help the Federal Reserve keep the interest rates unchanged for longer. So that means that lower than otherwise interest rates makes borrowing costs cheaper for companies, and hence it also supports valuations thanks to softer discount rate. And that's especially true for the big technology companies, where valuations rely heavily on future revenue prospects and increasingly on debt. So this week, investors' attention will be shifting to the US CPI update. Both headline and core figures may have further ease in July according to expectations, though both remain persistently higher than the Fed's 2% inflation target. Now, as usual, the reasoning is the same. A stronger than expected inflation report from the US this week will increase expectations of higher Federal Reserve interest rates in the coming months and could send yields higher and equities lower. A softer than expected figure, on the other hand, would soothe the hawkish Fed expectations and keep the market mood in the actual sweet spot. The activity on Fed funds futures today assesses no more than a 45% chance for a September rate hike from the Federal Reserve, and that's down from 60% before last week's soft jobs report landed on the market. And the US 2-year yield is now easing from its July peak levels, and the US dollar is being pressured lower by the building dovish Federal Reserve expectations today. The Fed doves also being bolstered by increasing questions regarding the new Fed chair Kevin Warsh's real intentions regarding the Federal Reserve's monetary policy, a discussion that I will keep for another time. So coming back, the softer US dollar and rising questions regarding Kevin Warsh's real monetary policy intentions and his real relationship with White House is helping gold recover these days. The $4,000 psychological level there acted as a solid support earlier this summer, suggesting that the market will eventually turn constructive if positive pressure on yields remains contained. And finally, in the FX space, the softer US dollar helps major pairs recover their recent weaknesses. The euro dollar is testing the top of the year-to-date descending channel these days, while the dollar yen is regaining its post-intervention losses. And speaking of that joint US-Japan action to save the yen last week, as in the previous episodes of direct FX interventions, well, the benefits will last only so long if the policy rates don't get adjusted in Japan. Markets now assess around 70% chance for a September Bank of Japan hike, and I don't think that is yet enough to stop the yen from bleeding back toward the 160 level against the US dollar. So this is all for this Monday. I'm İpek Özkardeşkaya and thank you for joining me today. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.